So I'll just tell you 2 points just before we started. Today's session will be completely introductory. Okay, so just to create awareness of what markets are, right? Just an introductory session. Let's not make it too complicated, getting into in-depth analysis. Okay, uh, considering beginners in the session. Okay, there are people who have to learn from the scratch. Okay, so putting that in mind, this will be completely introductory session because from our sides, from the training point of view, we have to consider the beginners as well, right? So people who are already knowledgeable and aware on markets, or who are already into trading from a couple of since a couple of years, so should be patient and then just go with the flow. All right, that's our humble request. Yeah. Okay, so then let's start with the introduction. So just please give your introduction. So what do you do? How long you've been into markets? Anything that you know about markets? Your name and your profession. Okay, you can start. Anyone randomly can start.
Hello.
Hi, Shubham.
Hi, sir. This is Shubham Jadhav here from Maharashtra.
All right.
Yeah, I'm a photographer. I'm an industrial photographer. I do shoots for 7-star, 5-star, and 4-star hotels for interior and food.
Oh, nice. Okay.
Yeah, yeah. And I started trading from last 1.5 year.
1.5 year.
Yeah,
Okay, that's nice.
yeah.
Trading in the sense, like, are you already, how do you do your trade? So
Yeah,
how was your setup?
actually, it's like an I just do in index only in
Mm-hmm.
Nifty 50.
Mm-hmm. Okay, like
Yeah. In
doing
starting,
analysis.
I was getting in paid calls.
Uh-huh. Okay.
And from them I learned some techniques, and I was studying whatever calls they have given to me, that I studied that
Acha.
on what basis they have given it to me and all. And after that I started investing by myself only. So I do it with myself only from last 1 year.
Great.
Yeah.
Hi all, this is Mahesh, and yeah, and I'm working as associate in Wipro company. I just recently joined in that company, and I'm beginner for this course and for trading.
Okay.
Yeah, hi.
Hi,
This is
Pawan.
Pawan. Yeah, so I'm working in HCL Technologies as a lead engineer, and I've been trading for the past 2 years. And yeah, obviously the portfolio is in deep red actually. I've
Okay.
really been a gambler in the sense it's
Okay.
either been paid calls or yeah, I've taken my own calls.
Mm-hmm.
Yeah, never maintained any risk reward nor stop loss, something like that. So, so want to rectify all those through your course.
Cool. Okay.
Hi, this is my name is Himanshu. I'm working in Reliance Jio Info Limited as a supply chain management. This is the first time to trading again.
Okay. So you're enthusiastic to learn. Okay.
Yes, sir.
That's a great decision.
Hello, this is Neelima.
Hi,
I am
Nilima.
homemaker. Yeah, I am new to this. I'm so excited to uh, know about trading.
Okay. So you're a beginner.
Yeah.
Fantastic.
Hi, sir. I'm Mahendra.
Hi, Mahendra.
Uh, I'm a student, sir. I have completed my second year, inter second year.
Okay.
Previously, in last past 10 years, my father had done stock market and he lost so much of money.
Uh-huh.
And I also interested in stock market, so I'm beginner. I just want to learn. So,
So it's in your blood, huh? So
yeah,
following genes.
yeah, sir, yeah.
Fantastic. Welcome, young man.
uh, there is a quote, sir, I have learned this. Where we lost, we have to find there.
Please again repeat your statement.
Where we have lost something, we have to find there. There only, sir. My father lost
That's
in stock
nice.
market, so I
Yeah, so you
want
want
to
to gain,
learn. Yeah,
give back to him, huh? Okay,
yeah,
nice.
yes, sir.
Great, great decision you have taken.
Thank you, sir.
Come on, introduce. We'll have to move on together from now. So we are a family now, right? So we need to know each other. Many people on the screen, but few talked. Come on, guys. So we'll move on to introduce yourselves. May I know Raj R? Who is Raj R?
Yes, sir.
I know your
Hello.
name as Raj. So
My name is Rakesh, sir. I am
okay.
from Maharashtra. Basically, I am mechanical engineer by profession, but entering trading field. So
Uh-huh.
I want to learn. I am as a beginner, not so much experience.
Mm-hmm.
Hello.
Yeah, we need not be experienced to learn. So we all are still learners, okay? And in fact, I am a
Oh,
mechanical engineer as well.
okay.
I've studied that course.
Even though I also
Thank you.
done diploma in mechanical engineering, sir.
Oh man, so we are all the same club here. Okay, so welcome Raj anyway. I have one
Thank you,
more,
sir.
yeah, no problem. Rajesh Kanaparti. So I'm not gonna leave you until you introduce yourselves.
Yes, sir. Already.
Oh, I'm sorry then. Okay, sorry. Uh, Richard Simon, they're on the call, right? Sagar Markand, Lihan Karti Dasari, B. Srinivas Nayak. I'm old batch student, but still I know that Sagar. So people will get to know you, right? Okay, Sagar doesn't want to speak and he wants to chat. Okay, Sagar, he's from Maharashtra. So he is our old batch student. Like he has taken the training for in the previous batch, and he still wants to learn more and he wants to get maybe clarification or something else. So he joined again. Lihan says he's from Vishakhapatnam. Seems like there are lots of people from Maharashtra. Probably, I guess. There's a lot of money in Maharashtra, isn't it? Fine. So most of them are beginners. Okay, so then let's get into the session then. BSc NSc also in Maharashtra. Okay, so let me introduce myself. So I am Srinu. I've studied my graduation in engineering in the stream of mechanical engineering, as I've already told you, and went for an IT job for 2 years, and then moved again into the stock market because my passion turned out into this. So before 2 years, I was a part-time trader. Now became a full-time trader as well as a mentor. Okay, so we teach technical analysis. So now I am a stock market analysis technical trainer. So with me, there's Suresh Kumar on the call. So we form our team. Okay, so we are the trainers for Bull or Bear Compound Wealth Technical Analysis Program. So just handing it to Suresh Kumar. Okay, so there's a lot of disturbance from Suresh sir. Anyway, maybe in the next session, so you'll get introduction of his. Okay, so and meanwhile, let's continue. Let me share my screen. Okay, all right, interested in share market. That's nice. Hope my screen is visible. Okay. Yeah.
Yeah, Srinu, it is visible.
Nice. So I once again give you a big welcome. So let's see what are we learning today or what are we understanding today. So we'll just understand what a stock market is. What is a company? Like you see companies on stock markets, right? That's what we always keep on discussing. So what's a company? How a company is formed? Who are promoters? What is FV? FV stands for face value. And what is it? And then we'll talk about premium. And then we'll talk about NSE, BSE, indices, IPO, market capitalization. IPO stands for initial public offering, which in detail will be discussed in the next coming slides. And then we'll talk about supply and demand. We'll talk about equity. We'll talk about futures and options. Okay, so just an introduction of or awareness of what these are will be given to you in today's session, because these are the things that you need to know. Okay, before you enter into markets, you have to understand what these are. These are the basic terminology, right? So as we learn in the schooling, right? So just going into the next classes, we keep on learning the basic things and then we move on. That's how things are. Okay, so let us understand what a stock market is. It's simply a place where one buys or sells shares of listed companies. Right. So what do you do in stock markets? You keep on listening on the news, you keep on listening on the TV. The stock market went upside, it fell down, there are profits, there are losses. What is happening? What do you see on the stock markets? You see companies on stock markets. Okay, and it's a place where you buy them, you have the feasibility of buying them, and you have the chance of selling them. Okay, you buy at some price and then you sell at some other level or some other price, and then you make profit, or you buy at some price or you sell at other price where you make losses. Okay, stock market is combination of both. You see both profits and losses in the stock market. Okay, it's a fact. And then minimizing your losses is a genuine thing as a trader. That is what you need to do, right? So okay, it's simply a place where you buy and sell shares of listed companies. Now how this is happening? Are you going to some store? Are you going to some kirana store and buying some company shares? Is it happening? Is that what you're doing?
No.
No, right? It's happening online. Okay, it's happening on just a click of on your mobile phone or on a tab or on your PC. It's happening online. So that is why it is electronically operated platform. That is why it is said to be an electronically operated platform, which is giving you the chance to buy and sell these company shares. Okay, and that it's because I said it's an electronic platform. There should be something which is helping that to operate, right? And that is a software. That's a software which is helping this to happen. or that is called NEAT, NEAT. So National Exchange Automated Trading. And why are they using these softwares? Because trading has to happen very quickly. You buy something or you sell something, it is happening online on your phone. And how is this happening? With the help of a software. It should happen with a software for these orders to take very quickly, for these orders to happen very quickly. That is why a software is used. All right, that's just a simple definition of stock market. You can get it, you can get more information on Google on stock market, and that's not necessary. All right. Now, I said, what do you see on stock markets? You see companies, right? Now, let's see what a company is actually and how a company is formed, and basic things that you need to understand about a company. Okay. Now, let's say we are some 10 on the call. Okay, just a wild guess. Okay, so we are 10 in number on the call. Now we have an idea. Okay, we have an idea of starting a business, right? Let's say we have an idea of starting a food business. We thought that this business can grow more in the coming days and can give us good profits. So we thought of starting this company. We came up with an idea, right? Now, do you think just an idea is enough to start this?
We need also investment.
Exactly. So not just an idea is important. We also need investment, right? We need a capital to start that business. Fine, we have to maybe to buy some machinery, okay, and buy something. If it is on wheels, we have to buy a truck, something like that. Whatever, we have to invest something, right? We need capital. So we also came up with capital. Let's say 10,000 rupees each. Okay, we came up with 10,000 rupees each. So now we have the capital. With that capital, we came up to start this business. Now, these 10 members who have got the idea of starting a business, right? The initial idea of starting a business are called promoters, because they are the initial root starters for the business. They are called promoters. All right. Are you with me?
Yeah, yes, Renu, continue.
Yes. Yeah.
Yeah, okay, great. So we came up with this 10,000 capital each. Now Mahesh says, okay, I have invested 10,000 rupees in this business, expecting some profits in the future. All right, fine. I invested 10,000 rupees now. So what do I get just because I invested 10,000 rupees? What is the benefit that I am getting? Okay, so there should be some benefit because we are putting our capital into it, right? There should be some benefit. Now, how that benefit is taken among us? It is taken, for example, we've built an office with this capital. Now, do we share this office physically? Let's say first floor you take, Mahesh, second floor Suresh, you take it, third floor you take it. Do we share like that? We cannot share the company physically, right? So what do? We take shares of that company. Okay, we'll be holders of these shares. We'll take shares of that company. Now, fine, we'll take shares of that company. But at what price shall we take is the question here. At what price we'll take the share? We'll take shares for that 10,000 capital. Now, for that, we'll have a board meeting and we'll decide the price of each share. Let us say we have met and we've had a board meeting. We discuss some factors, and let's say we have fixed 10 rupees per share. Okay, we have fixed the price of each share at 10 rupees. Now, how many shares would one get? 1,000 shares, right? Now, because you have invested 10,000 in your company as an investment, you are a holder of this 1,000 shares. Now, this 10 rupees, what we have fixed as the share price initially among the promoters is called face value. Okay, this is called face value. Now let's understand another term called premium. Why did this actually come? Okay, now we started our business. It started booming. It has been 1 year, 2. It has been a year and 2. So it's growing up. and we are seeing good profits. Now it's into the public talk. It's the talk of the town. Okay, now people are discussing about our company. Hey, okay, so and so company is performing good. Why don't I invest in that company? I want to buy some shares of that company because that's performing good and maybe it can give me good returns in the future. People started thinking like that. Now people from outside came to us and asked they also wanted to invest in our company. They also want to buy some shares in our company. Now here's a question to you. Now, do we give the share price at 10 rupees for these people also who have come up later?
No.
No.
No, right? So why is it no?
Because that time the face value has been changed. Value of that stock has been changed.
Others? Any other explanation for your no?
Demand of shares.
Okay. So it's just
Maybe
a simple
share price
logic.
is
The
increased.
market value of the company would have been more.
Okay,
Yeah.
let's not make it too complicated. It's simple logic. Okay, let's talk it in general. Now, just see, we have started business. Like the promoters, we the promoters have started the business initially. Now, the maximum risk. Who have bared the maximum risk of taking up this business? The promoters, right? Because we started initially, we built a base to it. We have laid a strong foundation to the business. We have taken risk, and then we have grown up in 1 or 2 years. Okay, the maximum benefit we have to take. People from outside, when they came up after 2 years later, why would we give them also at the same share price? So what shall we do? We will increase the price, isn't it? Did you get this point now? It's a general logic.
Yes, sir. Yes.
Okay, so now we will allot them shares. We will allot, but at an increased price, not at the 10 rupees we have taken. Let's say we've made it 20. Now that increased share price is called premium. Got it? Because we have to take the maximum benefit, right? These people came later, less risk involved in them because we have already built the environment for the business. Got this point?
Yeah, got it, got it.
Yeah.
So that's the premium. So that's a simple term that you need to understand. Okay. Now let's understand what NSE, BSE, indices, market capitalization, and IPO is. Let's talk about NSE and BSE. NSE stands for National Stock Exchange. BSE stands for Bombay Stock Exchange. So these are two different stock exchanges in the Indian market. For your information, Bombay Stock Exchange is the oldest one, and NSE, National Stock Exchange, is the recent one. Like it's the latter one. BSE is the former one. Okay, so these are the two different stock exchanges in the Indian market where you can put your capital into it and invest in companies. These are the two chances. So simply, I always compare the stock market with a vegetable market. That's an apt comparison where I'll be giving you all examples on that only. Okay, so we also have different types of different vegetable markets in our locality, right? We'll be having many vegetable markets like that. We have two different stock exchanges, and it's the option to you where you want to buy, right? So you have a chance to buy on NSE and buy on BSE. It's the same. The only difference is there you have vegetables and here you have stocks. Okay. Now, what do you see on these stock exchanges? I have already told you companies. Obviously, companies, right? That is what you see on the stock markets. But companies, and we here talk specifically about public listed companies. You always see only listed companies on the stock markets, not each and every company. Okay. Now, for example, let's say, just give me a quick name of some other company. Let's take an example of Bull or Bear Compound Wealth. It's a company. And do you see it on the stock market?
No, sir.
No, right? You don't see it on the stock market. You see HP, for example. HP company. Do you see it on the stock market? No, right? though it's a company, you don't see that on the stock market. Why? Because it's not listed. Okay, these companies are not listed. So let's talk what is listing. Let me explain that to you in the next upcoming slide. Okay, so that is why I said you only see public listed companies on the stock market. So these in other term you can call them equities. Okay, public listed companies, all these companies, or you can call it as equities. Now from now on we'll call it as equity only in terms of market terminology. Okay, we call them equities. Now TCS, that's a company, so that's an equity where you see it on the stock market because it's listed. Infosys, it's an equity. HCL Tech, it's an equity. Reliance, it's an equity. Like that, many other hell lot of companies. Okay, so let's talk about market capitalization. That's a term where it's formulated. Let's understand it in detail. Now, market capitalization is formulated as total allotted shares into CMP of each share. Now, the beginners can note of this. CMP stands for current market price. Current market price. It means where the price of that company or of that share is lying at that point of time. Currently, at that spot of time, what is the price of that share? That is termed as CMP, current market price. Okay, so market capitalization is total number of shares into current market price of each share. That gives the market capitalization of that particular company. Now let's talk more about market capitalization. In simple, you can also call it as the weightage of the company in the market. In other terms, you can understand market capitalization as the weightage of that company. It means the importance of that company it has got in the market in terms of some numbers, because it's number, right? Total allotted shares into CMP of each share of the price of that share. So that's why it's mathematically termed as like that. So in other terms, it's weightage of that company. Now let me give you an example. Just consider the Indian team. Okay, just consider the Indian team. For example, there's a match the next day, there's a match tomorrow, and just imagine the Indian team without Kohli. So what is the thought that people get in their mind?
It is somewhat weak.
Okay, so that's the thought people get into their mind, right? It's somewhat weak. Now, the team, no offenses here for the fans. Okay, so it's somewhat weak. Now the next day again, Kohli has come back into the team. Now, just what is the thought people get? It's strong now, right? Now, what's the difference here?
The capacity of the individual.
Exactly, right? So Kohli has got more weightage in that team, right? More importance in that team. Okay, now without him and with him, there's a difference, right? So likewise, few companies have their own weightage in the market. Now let me give this example in terms of stock. Now let's say one fine day, Reliance stock performed very badly. It fell down. It means the share price of Reliance has declined a lot. Now what will happen to the market? It will affect, right?
Yes.
Right. One fine day, Reliance performed, all the banks performed very well. All the banks, they have increased their share prices. They're on a bull run. Okay. They're on a bull run. Now what happens to the market?
It is also
Increases, right? See, now the weightage, that is also important. So the weightage, so they have got their own, weightage. Now let's talk about, let me give you an example of capitalization in terms of the numbers. I'm sorry, it's asking for request access. Okay, so we'll just look into this in the end. Right, now let's talk about another term called index. Okay, I don't know if you're well aware of this. Nifty 50, you'll be hearing this very familiar. Nifty 50, Bank Nifty, and all these things. So these are index. That's called an index. Let's understand why it is called an index and what is an index actually. So simply, index is the measure of the performance of an economy or of the markets or of various sectors in the country. What's going on in the country in different sectors in terms of their economical value, in terms of their market performance. So that is measured in terms of some number, right? That performance is measured in terms of a number. That is called an index. Now, for everything we have a measure, right? How do you measure milk? With some measurement, right? You say it in liters, isn't it? That's a measurement. How do you say the quantity of water or quantity of milk or quantity of rice? You measure it with some term, isn't it? Like that, the performance of these markets in different sectors is measured in terms of something. That something is called index. Okay, so like that, we have two indices, one Nifty 50 and Sensex. Nifty 50 and Sensex. Of course, there are many indices as well, but let's just talk about only these two. These are the main important things. Okay, so Nifty 50 and Sensex. Sensex, in other terms, it is also called as Sensex 30. You can call it Sensex or Sensex 30, but in short, people call it Sensex. That's it. Okay, now let's talk about Nifty 50. What is Nifty 50? So Nifty 50 is acronym for National 50. National 50. And why is that 50 specific? Why is it not 100 or why is it not some other number? What is Nifty 50 actually? So I told it's an index, right? So firstly, Nifty 50 is an index. But why it is National 50 only? So let's talk about that. Now, for example, let me, I'm trying to give you another example. Okay, let me walk you through an example of Delhi. Okay, Delhi, that's a well-known city, right? Now you call Delhi as most polluted city, isn't it? Delhi is the most polluted city. That's in general. Okay, now do you think each and every part of Delhi is polluted?
No, sir.
May not.
No, right? The major parts of Delhi are polluted, and in general, you call Delhi is polluted. Now you say Bangalore is the cleanest city. Now, do you think again every part of Bengaluru is clean?
No.
No, right? The major important areas or the major familiar areas are clean, and in general, it has been stated as the cleanest city. Got my point?
Yes.
Now, likewise, to assess the economy or to assess some parameter of the whole country, do you need to consider each and every company?
No, sir.
Cannot.
All performing
No,
companies.
right? So just considering the performance of top 50 companies in different sectors, that is measured with this index called Nifty 50. Got it?
Okay.
Okay, now top 50 performing companies in IT sector, in banking sector, and in industry, some real estate sector, in all different sectors. All these top 50 performing companies form the index Nifty 50. So these companies' performance index is enough to assess the whole performance, isn't it? Like that. So like that, Sensex also. Sensex 30. The number gives you an idea. 30. So it's the top, it's the index for top 30 performing companies in different sectors. Now Sensex is handled and maintained by BSE. Nifty 50 is handled and maintained by NSE, National Stock Exchange. So now idea on Nifty 50 and Sensex. So you say Sensex fell down, you say Sensex rose. So that's what you keep on hearing early in the mornings and late evenings, right, on the news. Nifty 50 has declined, Nifty 50 has risen. So what are all these things? Right, so these two are the indices. Now let's talk about another term called IPO, initial public offering. Right, now let's come back to the before second statement. As I've told you, you see listed companies, right? Now here comes the concept, initial public offering. Now what is initial public offering? The name itself, the abbreviation itself says initial public offering. You are initially offering the public something. It means you are going public. As a company, you are being listed into the public so that people or investors or from outside, they can invest in your company. You're offering them that chance. That is why it is called initial public offering, IPO. Now, what happens if you do this And what happens after you do this? Now, when you go public or when you go IPO, when a company goes IPO, it will get listed on the stock market. Probably now you have got an idea why I have stressed on the listed companies. So now you cannot just see each and every company on the markets, but you see only listed companies. Now listing here is you have to apply for the process of initial public offering IPO. Then only your company will be listed on the stock market as Infosys, as TCS, as Reliance. Only if your company is listed, it will be seen on the stock market as an equity. Is this clear? So that is IPO. Now I have a question to you. So why do you think a company has to go this process of IPO? Why do you think they have to go through this process of IPO? Why actually?
To get the
raise
capital.
Exactly, to gain capital. So it's
To
simple. Yes, Shubham.
To let people know that this company has been listed on BSE or NSE.
Okay, all right. That's a valid one. In simple, to raise funds, isn't it? Now let's take the example of the same one that we have taken initially. So now we, the promoters of 10 people, our company is not listed. So how do we go into public? How do we raise funds? We have finished the capital in our hands and we don't have much capital left with us to run the company for 2 or 3 years more, increasing our branches, increasing our machinery, and increasing blah blah blah, whatever. We need more funds for it, right? How do we get? We are shortage of funds. We are short of funds. We don't have enough funds. How do we get it? No other chance, right? So that is why
IPO.
that's why we go into public, so that we raise funds. Okay, so that is IPO, initial public offering. Now this can be an advantage, right? So now for this process, IPO, initial public offering, so there are advantages and disadvantages as well. Remember, there are both things. As in general, in nature, everything has its own advantages and disadvantages, right? So IPO also has its own advantages and disadvantages. Let's talk few. Now let's see the advantages. As you already have understood: fundraising, publicity, publicity, fundraising, and reduced overall cost of capital. Yes, that will be reduced. How? Initially, when we weren't listed into the IPO, we 10 people only have to deal with these things, and our capital will increase as we only have to invest all the things, right? No other people from outside will invest, or for any other thing that we want to improve our branches or whatever it might be. Okay, now if we are now into the IPO or after the IPO, if we are listed after we have raised funds, now individually our costs will decrease, isn't it? Are you with me?
Yes.
Yes, sir.
That's an advantage. And few disadvantages are, let me tell you the disadvantages. Now this process of IPO filing is has to be done under some regulatory body. It cannot be done easily in a word. Now let's say Bull Bear Compound comes and says, hey, I want to go for IPO and list me on the stock market. It doesn't happen that easily. I'm sorry, Pawan, can you go on mute, please? I get some disturbance. That's great. Thank you. So that process is not an easy one. What the IPO process? So you have to go through some rules and regulations. You have to abide. You have to abide by the rules of a regulatory body called SEBI, the Securities and Exchange Board of India. So you have to listen, or you have to be under it. Like you have to abide by the rules and regulations imposed by SEBI. That's sure. That's mandatory. Okay, that's a disadvantage. Now you'll not have your own powers. Understand that. You'll not have your own powers. Okay, so that is one disadvantage. And number two, this process of IPO is very costly one. It's costlier. Okay, the transaction costs are heavy, imposed by SEBI. So that's a drawback, right? That's a drawback. Now, the third important drawback is, let me frame that to you in an example. Now let's consider two scenarios of considering one company. Let's consider two scenarios: before IPO and after IPO. Okay, before IPO and after IPO. Now let us say Mahindra has some company. He owns a company, a chappal manufacturing company. Okay, that's his company, like chappal manufacturing company. Now we are talking about the before IPO scenario. It's his own independent individual business, right? Before IPO, he hasn't listed on the market, stock market. It's independent and it's irrelevant of the stock market. Now one fine day, Reliance fell very badly in the stock market. It performed very badly. It declined a lot, which dragged the markets down. Now, do you think Mahindra's business of chappal manufacturing will affect? He also will get into losses. Will that happen?
No, sir.
No.
No, right? Why? Because it's his own independent and irrelevant business to the market. Only if his chappal sales goes down, then only he'll make losses. Or else if his chappal sales are good, he'll make profits. That's it. What if Reliance performs good or bad? Yes, right? It doesn't affect. Is this point valid? Clear?
Yes, sir.
Yes.
Yes, sir.
Alright, now let's get into scenario 2. After IPO, it means now Mahindra has listed his chappals manufacturing company on the stock market. He has filed for IPO. Now he's a part of the market, integral part of the market. Okay, he has filed IPO. Now one fine day, the same day, Reliance again fell down very badly, which dragged the markets down. Now do you think Mahindra's business will affect?
Yes, it will affect.
Exactly, to some extent it will affect, because he also Mahindra's business is also the part of the markets now, right? He is integral part of the markets now. Okay, the participation in the markets will also get affected to his business to some extent. Okay, now this effect is called market pressure, right? The market pressure has impacted on his business here, isn't it?
Yes, sir.
Yeah, so that's called market pressure, and that is a drawback, okay, for IPO. That's a minor drawback. Anyway, to gain something you have to lose something, isn't it? There's a saying, right? So the same applies there. Okay, so that's a drawback. So these are few advantages and disadvantages of a company, for filing IPO. Is this clear?
Sir, what are the reasons for market pressure? Can we know, sir?
Okay, what do you think the reason is here? Because you are an integral part. Now, if you think, if one, or let us say few traders think that Reliance is performing badly, few investors started taking off their positions. Let's say they started selling. So when selling enters into the markets, what will happen? When there is a huge supply there, what will happen to the demand?
Fall down.
Simple.
It will fall down, sir.
That's it. Okay, stock market is all about supply and demand. It is simply all about supply and demand. That is it. Nothing else is in stock market. It is all completely about supply and demand. And that supply and demand, you have to understand it on the charts. That is it. Theoretically, on the charts, you have to understand the supply and demand. That's it. Then you'll rock the markets. Okay? You need not you need not study something else. It's not a rocket science at all. Right?
Right, sir.
Okay.
But sir, I had a question.
Yes, please.
Miss, I understand you. I understand. Miss, I understood the term of that term, market pressure.
Okay.
To know that how can different companies affect to each other, like Reliance in different sector, or as we discussed, like I considered Mahindra as having a chappal manufacturing company.
Okay.
So both of those are from different sector companies, right?
Yeah.
So how does those get affected from each other or from different sectors?
Now that's where the index come into picture. That is what we have talked about. Index.
So basically, it's like if index, how the index performs, that affects on each and every company.
Okay, let me give. Now index. So we talked about index. Simply, index is the performance of the group of that companies, right? Different sectors. Now, let's say different banking sector stock. There are a hell lot of banks. There are different banks. Let's say ICICI Bank, HDFC Bank. Now, When ICICI Bank is falling down, do you see HDFC Bank going upside?
No, not for much time.
Exactly, right? So that is what market pressure is. To some extent, it will affect. I'm not telling you to the completely extent if that falls, if this will fall. It's not at all like that. But to some extent, due to the market pressure, due to the selling of people, panic sell. That's called panic selling. Now, when one
Yeah, I
is
got.
going
I
down,
understand.
what Shubham will think, oh, he'll panic and he'll try to sell off. That is the same thought other people will get into his mind. Okay, that is the same. He or she also will repeat. He'll start selling.
Okay.
Okay, that's where the pressure will it will try to diverse like that.
Okay.
Got it?
Yeah. Yes, sir.
Cool. Okay, the important one. Just now I've given a statement, right? So it's all about supply and demand. So these these are simple terms which are ruling the markets.
One question, Srinu.
Yes, please.
Uh, how these indexes will work?
I didn't
I
get your
mean,
question clearly.
how the company? No, I just want to see how the indexes works for the company.
Clear a question, please, again. So how do you get the value of it? That is what you mean to ask, or how is
So
it? Now, I'll
index
tell
is
you. Yeah.
the
There are just the same example as I've told you. No, different. There are different types of banks, right? So all these banks are grouped together. Okay, the performance of
okay.
all these banks, the differences or the movements of the share prices of all these banks, okay, is
Okay.
calculated and shown in terms of an index like Bank Nifty. Or
Okay.
there are different sectors. Like I'll give you an example. You know the IT sector very well, right? IT sector. So there are
Yeah.
different companies in this sector, like HCL Tech, TCS, Tech Mahindra,
Yeah.
okay, Coforge, okay, Mindtree. All these are IT companies. These are all different companies performing under the IT sector. Now, as I've told you,
Yeah.
how these we need not measure each and every performance of each individual stock, right? So all these are
Yes. Yes.
grouped together
Only major part
and it
is
is
enough.
shown in terms of an index like Nifty IT. Like that, there is Nifty Realty. Like that, there is Nifty FMCG. FMCG stands for fast moving consumer goods. Nifty
Okay.
FMCG, Nifty IT, Nifty Pharma. How all pharma companies are performing, it is shown in terms of index called Nifty Pharma, Nifty IT, Nifty
Okay.
Realty, Nifty Automobile companies. Okay.
Yeah. Okay.
Okay, let's come back again to the supply and demand, right? So these terms are really simple, supply and demand. So what is the thing that you know about supply and demand? You have been hearing it, since ages. Supply and demand. What is it?
If there is a huge demand in market, and then the price of the stock will get increased, and if there is a if volume of demand supply is more than the demand, then your stock value will be decreased.
Perfect. Yeah. In simple, putting it simple, supply and demand are always inversely proportional, right?
Right, sir.
If one increases, the other decreases. Now,
Right.
let me give you an amazing statement. Now, have you ever seen a stock always going higher and higher and higher?
No, sir.
No,
Never.
right? Everyone, it always doesn't go higher. Any stock, can be it any stock, it will not at all go higher and higher and higher. At some points, it will fall down. Okay, that will happen. That is the nature of markets. Prices will increase and prices will decrease. So they continuously will not decrease, or they will not continuously increase. So there are ups and downs in the markets. So that's the nature, right? Be it any company, be it any company. Now, here, if we ask a question to ourselves, why is this happening? Why is the price increasing suddenly, and why is the price from that point is decreasing suddenly? If you question that to yourself, And there comes the picture of supply and demand. Okay, so when there is a huge supply of that stock, obviously the demand for that stock will fall down. That is why the price of that stock will come down. And when there is a huge demand for that stock to buy, when there is huge demand in buying that stock, the price will start increasing. So that is happening in the markets. And that supply and demand, where it is located, that is where you need to find as a technical student. That is your analysis. Reading the charts. What are you doing reading the charts? Actually, we say reading charts, reading the charts. What are you doing in reading charts? Simply you identify these levels. Simply you identify these supply zones and demand zones. Identifying these zones, you act accordingly. Then you'll understand what is happening to that stock, whether it's a buying zone or whether it is selling zone, whatever. Okay, now let me give you an example. So I told you that stock market is compared to the vegetable market, right? So let me give you that example. Now let's consider a vegetable market. So there are two sellers of tomatoes in the markets. There are two people, so they sell tomatoes. Now 10 people from outside went into the market to buy tomatoes. So what do you think the prices of the tomatoes would be? Increase or decrease?
Increased.
Everyone. Simple logic. That's daily thing. Increase or decrease?
Increase, sir.
Increase.
Others.
Increase.
Increases, right? Why?
Because there is the demand is more than the supply.
Right? Simple. So the supply is less there. The stock of the tomatoes is very less there, but the buyers are more. Right? Buyers are more. Buying demand is high. Buying demand is high. All these 10 people want to buy tomatoes, right? All these 10 people want to buy. Now Lihan also wants to buy, Mahendra wants to buy, Rajesh wants to buy, but there are less number of tomatoes there. So Lihan says, hey, okay, there are less number of tomatoes, let me pay high and then grab the tomatoes. Mahendra says, let me pay more and grab the tomatoes. Rajesh says, I'm ready to pay more and grab the tomatoes because there's need. The necessity is high there. So that is how the price started increasing, isn't it?
Right, sir.
So there's demand, the demand is high there, the prices started increasing. Same thing happens in the stock. When there is intense buying or necessity happening in that stock, the price of the stock increases. That's it. Now let's take another example. There are 10 sellers of tomatoes in the market and 2 people from outside went to buy them. Now what do you think the prices of the tomatoes would be?
Prices will be decreased.
Decrease.
Obviously decrease, because less number of buyers there, more tomatoes there. It means more supply, more stock. But buying demand is very less, right? So all these 10 sellers, what do they think? Hey, only 2 people came to buy tomatoes, so there are no more buyers. So my tomatoes wants to be sold. My tomatoes wants to be sold. The second person, third person also says the same thing. And to be for the tomatoes to be sold, the first fellow, what will he think? I'll try reducing my price. Second fellow will think my tomatoes also wants to be sold, so let me decrease the price more. That's how the price started decreasing, isn't it?
Right, sir.
Exactly, that's what's happening on stocks. So that's the concept of supply and demand theory. Okay? All right. Let's get in. Are you with me? All clear?
Yes, sir.
Yes, yes, sir.
Okay, now just look into this slide. Okay, now talking about trading. So where you can trade, what are you trading actually? So you have different segments in the stock market where you can put your money into, where you can trade. I'm just talking about trading here. Now there are two options where you can enter into markets. You can either trade or you can either invest. Investing is again a different concept. So investing, I'll just put that in a simple statement. Okay, so investing is putting your capital on a stock or on some shares, simply buying some shares and holding it for long term, expecting some returns out of it. That is investing, be it a year, 2 years, 3 years. Patient people wait even for 10 to 15 years, 20 years, long terms. Okay, that's investing. Now let's ignore that as of now. Trading is just you buy a stock and you immediately sell it on the same day or the next day or the next week. Okay, so that's trading. It's very short term, very short term. The time is not fixed, but it's very short term. You buy it and you sell it immediately. That's it, and you make profit out of it or a loss out of it if your analysis is wrong. Okay, so that is trading. Now, what can you trade actually in the markets? There are different segments where you can trade upon. So they are equity, futures, and options. Futures and options and equity. So these are the different segments available in the Indian stock market where you can trade upon. Now, as I told, let's understand the differences between these. Okay. Now let's say equity. We already talked about equity. So what's an equity? It's simply a listed company. So in other terms, theoretically it's defined as the underlying asset is called an equity. The underlying asset is called an equity. Now what do you mean by underlying? The main basic root is called the underlying. Now let us say you see TCS, okay, Tata Consultancy Services. TCS, that's an equity. That is a main asset. That is an underlying base root asset. HCL Tech, another IT company, that is an equity. Reliance, that is an equity. Okay, so let me give you an example comparing it to a simple one. Let me give you an example of milk. Okay, milk. Now out of milk, many products are made, right? Ghee, curd, buttermilk, all these are made out of milk, isn't it?
Yes, sir.
Yes. Now here the milk is the main asset, right? That
Yes,
is
sir.
a main underlying asset. So that is an equity. Now from that equity, the other segments derived are ghee, curd or buttermilk, whatever, etc., many other products. All these are called derivatives of milk, isn't it? Because
Yes.
these products have
Yes.
been derived from the main underlying asset, which is called as equity. Here, milk. From that, these products have been derived. That is why they are called derivatives, because they have been derived. And what are these derivatives in the market then? In the example, they are milk, they are buttermilk, curd, and some other ghee. But in terms of in market, what are the derivative segments? They are futures and options. There are two derivative segments which we need to understand and discuss. They are futures and options. So options is a derivative segment of equity. Likewise, futures is a derivative segment of equity. So now you have three options. You can trade on equity, or else you can trade on its derivatives. It means you can trade on futures or you can trade on options. Now on what to trade, it depends on your knowledge and the capital that you have. Is that point clear?
Yes, sir.
Okay. All right. Now again, let's come back to the same example that I've given. So if the price of milk increases, what will happen to the price of curd?
Increases.
Increase
Simple logic, right? What will happen to the price of ghee?
will increase
Increase. Now, why do you think the prices of these derivative segments is increasing?
because the main portion of it is increasing. Value of main portion is increasing.
Exactly, because the main underlying asset, which is a root of these products, is increasing. Obviously, the byproducts, the derivative segments price also will increase, right? That's the logic. Clear?
Yes, sir.
Okay, now this is clear. Now let us discuss more about these equity, futures, and options. Now, why did these futures and options come into existence actually if you have the chance of trading on equity? That is the main question that comes actually. Why did NSE and why did they, the implement of this concept of futures and options if you can trade on equity? Okay, let me give you the justification for that. Now I said equity is the main underlying asset. Now there are few differences in between these two things that you need to understand. Like, now let's consider an example of Asian Paint. That's a listed company on the stock market. So that's an equity, right? Now let's say the share price of Paints is 2000 rupees. Okay, let's say the share price of Asian Paint is 2000 rupees. Now you have 10,000 capital. So with that you want to get into the markets. You have 10,000 capital. So how many shares of Asian Paint you can buy? Can you buy?
5.
5 shares, right? So you can buy 5 shares of Asian Paint here. Now, why are you buying the shares of Asian Paint here?
Because I see potential in it.
Okay. Simple, right? Why are you buying actually? Why are you buying something? Because you think that it will increase or it has potential to increase. The share price will increase so that you'll get some profit out of it. That is why you are buying. All right. So you have bought 5 shares of Asian Paint at 2000 rupees. Now it started moving upside. It went to 2005. So it gained 5 points. It gained 5 points. So what is the profit that you make?
25.
25 rupees, right? So 25 rupees is the profit that you make. Okay. Now 25 rupees is the profit that you make. For example, it started going down. Your analysis went wrong. Soon after you bought the shares at 2000 rupees, it started going down. It went to 1999. It went to 1998. It started going down. It means you are making loss there now. Yes?
Yes.
Right, sir.
You are making loss there. So that's how you make profit and losses based on these things. So you buy at some price and you sell at some price. Now, one more major difference is equity trading involves less risk and less reward. But futures and options involves high risk and high reward. Futures and options involves high risk and high reward. Equity involves less risk and less reward. Now this I'll show it to you now with an example on a sheet so that you'll understand. I'm just terming it in short form FNO, okay, futures and options, equity. So in other words, what did I tell you this? It is underlying asset, okay? And what is this? It's derivative segment, okay? And other term for FNO. What is it actually? FNO, futures and options, they are simply contracts. Just remember this term. Okay, they are simply some contracts. Futures and options are contracts that where you bet upon. And how do the value of this FNO varies with respect to equity? Is this point clear? If equity value increases, the futures value of that company increases, or the options value of that contract increases, right? If the value of the equity decreases, the value of the futures also will decrease. Is this point clear?
Yes,
The value derives from the underlying asset only, equity. Okay, so what is futures and options? They are simply contracts. They are simply contracts. Now, let us say, what did I say? The point is, equity involves less risk and less reward. Less risk and less reward. Okay, now let's say, why did I tell you that statement? Equity. So I'll explain that with an example. Less risk, less reward. Now, why did I say less risk? because of one term called expiry. There is some term called expiry. This is where you need to understand. Now, what is this expiry actually? So, equities are always eternal. So, it means equities don't have expiry. They don't expire. They are lifelong. They are long time. Okay, until you have the capacity of to trade, until you exist, equities exist. Okay, they don't expire. So, in the previous example where you bought some shares of Asian Paint, when the analysis was wrong, it started going down. When you started making loss, there is an option, or there is a chance of that to recover back, right? There is a chance of that to recover back. Asian Paint, example, you bought on Thursday. Let us say you bought on Thursday and it started going down. You can wait for the next day, Friday, wait for the next day, Monday, wait for next week, wait for next month, wait for next year, wait for another year. It has a chance to come back again, right? And you have the chance to wait forever, because equities do not have expiry. They don't expire. It's all about your patience. You want to wait. Did you get this point?
Yes, sir.
That
Yes,
is
sir.
why there is less risk involved in equity.
Yes.
Now here the risk is very low, right? Because when it went down, if you are patient enough, it will again come back to your price. Less risk. Again, it started moving upside. Fine, you are waited. You waited, and it gave you good. It gave you good profits. So you got a reward. Now, if Asian Paint moves by 1 point, what is the profit there you are making? 5 rupees, because you have bought 5 shares, right?
Yes, sir.
So there is less reward also involved in it, because less risk. That is why less reward. Now, for example, we have taken the example of share price of Asian Paint is 2000, right? Now, to buy 5 shares of shares of Asian Paint, what is the capital that you need?
10,000.
10,000. Okay. Now let's come back to FNO, this segment. I told you this is a contract. Now, what do you mean by a contract in general in English? What is a contract?
Agreement between two persons.
Agreements are eternal?
No, sir.
No.
No, right? Agreements have a deadline, isn't it? Agreements have a deadline. They have a specific period of time. That's it. And after that, that agreement is closed. So the same thing happens here. So that is why FNO are high risk and high reward. I just gave you an example for risk, and I'll explain you why it is less reward and why it is high reward. Okay. So that is why this derivative segment of FNO involves high risk and high reward. Now let me tell you why. Because these contracts have expiry. It means after a certain date, or after a certain amount of time, this contract will die. It will expire. So there are weekly and monthly expiry. Anyways, you'll be getting to know in detail in the further sessions. So, but just for now, just understand there will be expiry for each and every futures and option contract for any company. Now, let us say you want to trade on FNO segment of Asian Paint. You know that you should be aware that there will be expiry for that contract, because it's a contract, right? It's a contract. Now, let us say by some analysis you understood that Asian Paint will go high. You want to trade on options. Let us say you want to trade on option segment of Asian Paint. So you bought some option of Asian Paint, or else you bought some futures contract of Asian Paint. Your analysis went wrong and it started going down. Asian Paint started going down. Now it means you started making loss, isn't it?
Right.
You are into losses now. You waited for the next day. You waited for the next week. You waited for the next month. You waited for the one more month. Come on, you don't have a chance here. You don't have a chance to that waiting period. You don't have chance. You cannot wait. Why? Because it will expire on some date. For example, let us say for any stock option, the expiry is 1 month. Okay, it means the last Thursday. Thursday is an expiry day. Thursday is considered as an expiry day. Okay, so every last Thursday of that month is expiry day. It means your contract, whether be it futures contract or options contract, it will expire on that day at the time of market closing. Whether you are in losses or profits, it doesn't matter. Your contract will expire. It means you have to exit it at any cost with profit or loss, whatever. If your analysis went right, maybe you would be in profits. If your analysis went wrong, obviously you have to exit with huge losses because the contract will expire at any cost on that day. Got it? That is why high risk is involved in derivatives, this segment of futures and contract, futures and options, because it's a contract. Now you got it why high risk is involved. Now, as in equity, you don't have to wait. You don't have a chance to wait. At any cost, you have to exit on the last day of the expiry day. Clear?
Yes, sir.
Okay, so that is why high risk is involved in this FNO. Now, risk hai to ishq hai na. So where there is high risk, high reward also is applicable, or that is granted. Now let's understand how reward is high in this case. Now just understand one point here. How are you making profits in equity here? Now if equity is moving by 1 point, you are gaining. Let us say you bought 1 share of Asian Paint at 2000 rupees. If Asian Paint equity gains by 1 point, what is the profit that you make?
1 rupee.
1 rupee.
1 rupee. Now here, let us come to F&O segment. Now here you will make more profit. Let us understand how that happens. Now in equities, it is up to you how many number of shares that you want to buy. It is up to you. You can decide based on your capital. Now here I have only 2000 rupees, so I bought only 1 share. It is up to my decision. If I have 5000 rupees, I'll buy 2 shares. Okay, it is up to my wish. I can select here the number of shares that you buy. It is termed as quantity in terms of market language. It is termed as quantity. Okay, I'm buying 1 here, 1 quantity based on my capital. But in FNO, but in this contract segment, it is not up to your wish. You cannot decide that you want to buy 1 share or 2 shares like that. Here it is in terms of lots. Okay, here it is in terms of lots. So you have to buy, definitely have to buy in terms of lots only. You can buy 1 lot or 2 lots or 3 lots or 4 lots or 5 lots based on your capital, but in terms of lots only. Now lot sizes will differ from stock to stock. For example, Asian Paint option contract has a lot size of 300. So now you have to buy 1 lot for sure, minimum of 1 lot. So how much quantity you are buying here?
300.
300. If you have more capital, if you want to buy 2 lots, you are buying 600 quantity. If you are buying 3 lots, you are buying 900 quantity. But mandatorily, you need to buy in terms of lots only. It is not up to your decision. You cannot buy you cannot change that. Okay. Now let's understand here. For example, you have bought 1 lot in this segment in options contract. So it means you have bought option contract of 1 lot of option contract of Asian Paint. It means how much quantity you have bought?
300.
Okay, 300 quantity. Now, if this price increases by 1 point, here in equity you are gaining 1 rupee. But in FNO segment, if this equity gains by 1 point, okay, if this gains by 1 point, here you will be gaining profit in terms of lot sizes. Okay, if that option contract increases by 1 rupee, you will be 1 point, you will be gaining 300 rupees. Why? Because the lot size is 300, right?
Right, sir.
Okay, now
One doubt, sir.
exactly, yeah, you can answer.
Sir, the price may be more, no, sir, here for 300.
No, it's fixed. It's fixed. Lot
My
sizes
doubt is, sir, My doubt is, sir, for one share you are purchasing with 2,000
Okay, here, yeah.
in equity.
Yeah, equity.
In options, it will be 2,000 only for 300.
No. Actually, there's one more concept of premium here, option premium, that I don't want to discuss in a very basic session. That is the reason I didn't tell this. Okay. So in the upcoming sessions, you'll understand that how options work, how options and futures work. You'll be understand. So just giving you a basic idea of risk and reward ratios. That's it. Okay. Right. Now, in this segment, in this FNO segment, now what is a multiplier of your profit? The multiplier is lot size. Remember this. Okay, the lot size is your multiplier. Here, the quantity is your multiplier. Based on the quantity you take, your profit or loss will change. Based on the lot size here, your profit and loss will change. So that is why here high reward is involved. Here less risk is involved. Okay. So just gave you a brief idea, or just showered you some idea on how equity and FNO is. Okay, now let's again get back to this thing. Okay, so these are the derivative segments, futures and options. Now futures is not again categorized. Options again is categorized in two types. One, a call option. Number two is a put option. Now let me tell you quickly what is a call option and what is a put option. When do you buy it? Now, when you think equity will go high, by some analysis, you say equity is about to increase or equity will go high, you simply buy a call option. When you say equity will fall down, when you say equity will decrease, you simply buy a put option. That's it.
Sir, okay. We have to choose by company, sir.
Yeah, company. Every company, not all the companies, most companies will have options and futures as well. So I don't say all companies, but not all companies will have futures and options. Few companies will not have. So you have to choose. If you want to trade in option segment, you have to choose the company which has options in it.
Okay. Whenever we know the share price is increasing, then we have to go for call option.
Exactly. You have to buy a call option. If the share price is decreasing in equity, you have to buy a put option. Okay. It's just a basic idea. In detail, you'll be learning it in the upcoming sessions. All right. So this is about equity, futures, and options. So with this, I'm done with the teaching part on today. So all concepts clear and neat.
Yes, sir.
Very basic and introductory session. Maybe the people who are already aware on this have been bored, but you have to be patient. It's just a brush up. Okay. Anyway, basics are important and you have to know basics, right? Yeah.
Yes.
Okay. All things clear and perfect.
Yes, sir. Yeah, bro. Yeah, clear.
Okay. So how well you loved the session?
12 out of 10, sir.
Wow, that's nice. Thank you.
10 of 10, sir.